Hi, I'm Stuart Jackson, Senior Analyst at Montgomery Investment Management. Welcome to this week's Video Insight. In this week's video blog, we take a run through the first half results of the major banks. There are 5 main components of a bank's result that we really focus on. First, there's the growth in the loan book. There's the change in the net interest margin, or NIM, operating cost growth, bad debt provisioning and changes in asset quality, and last, changes in capital and liquidity ratios. The main areas of surprise from the results were the disappointing net interest margin improvement and weaker than expected non-interest income. Net interest margins benefited from mortgage repricings during the second half of calendar 2015. However, this was offset by aggressive discounting of new mortgages, as well as the impact of increased competition in New Zealand and increasing funding costs due to rising wholesale funding spreads. As a result, the performance on net interest margins was generally disappointing, largely remaining flat to lower than the prior corresponding period. Non-interest income growth generally disappointed as well. Of particular concern was the weak fee and commissions revenue growth for all of the banks. This is likely to persist given further tightening of credit card interchange fee regulations in the near future. Operating costs produced some divergence between the banks. The market liked ANZ, and that ANZ has bitten the bullet on its cost structure, but it will need to reduce the cost base pretty quickly to offset the impact on interest income from pulling back in Asia. Additionally, we are yet to see the impact of significant headcount reductions on revenue in areas such as trading, FX and markets. We were most disappointed with the cost performance of Westpac. Comparing the cost base on a like-for-like basis, operating costs increased over 7% on the prior year. On the bad debt provisioning and the quality of loan books, these were always going to be a focus for the market given the number of companies reporting difficulties during the period. Provisions were higher than expected for Westpac and CBA and around levels guided to by ANZ, albeit well up on the prior year. They were lower for NAB. In the case of NAB, the low provision charge raises the question of whether this performance will reverse in future, given that it appeared to take a less conservative stance on the individual provisions against its loans in companies like Dick Smith, Arium and Peabody relative to the other banks. The Westpac result flagged increasing issues in personal lending and particular auto. This could be the start of signs of pressure more broadly in the household debt repayment segment. Arrears on mortgages increased marginally from low levels for all the banks, with most of the increases due to a deterioration in Western Australia and Queensland. The banks claimed that despite some pockets of problems, the overall book remained strong and pointed to the high proportion of mortgages that are ahead on their payments. However, it's not the 72% of Westpac's or 40% of ANZ's Australian mortgages that are ahead on their repayments that I'll be worried about. The other 28 and 60% can still do significant damage. Issues in certain markets in Asia remain of a concern for ANZ, as does exposures to mining and residential commercial property for all of the banks. An increasing issue is exposure to the New Zealand and Australian dairy industries, given the collapse in export commodity prices. The results showed a jump in impaired assets. ANZ and NAB have the most exposure to this sector according to their result presentations. On capital ratios, these were generally slightly softer than expected, particularly once the ratios are adjusted for regulatory changes that will be implemented from July 2016. Leverage ratios are largely in line with expectations. The need to accelerate the rate of capital accumulation led to the decision to cut ANZ's dividend payout ratio. We note that management flagged a long-term dividend payout ratio below what was implied by the interim dividend, meaning the dividend growth is expected to remain below earnings growth in future periods. Overall, the results were slightly weaker than expected due to the weaker net interest margins and fee revenue. With the banks passing through the full 25 basis point rate cut to variable mortgage rates, net interest margins are likely to come under increasing pressure over the next few months, given they are unlikely to recoup the full rate cut through repricing of deposits. That's all for this week. We'll be back next week. In the meantime, you can follow us on Facebook and Twitter.